Hey everyone, welcome to my very first day trading video. I go by Resident Trader 5 and for the past 5 years I've been studying the markets and building my edge. Today I'm proud to say I'm a funded trader, which means I trade with a firm's capital instead of just my own money. Passing a funding evaluation proves you have risk management and consistency, and the firm backs you with either real or simulated capital. In this video, I'll walk you through my journey, my strategy, and some live examples. Before we dive in, I want to be clear. Trading is not a guaranteed path to easy money. In fact, most retail traders lose. Different studies and prop firms show that over 80 to 90% of traders fail to stay consistently profitable. But that doesn't mean it's impossible. I've spent 5 years learning, refining my approach, and managing risk. That discipline allowed me to pass a funding evaluation and become a funded trader. So while the failure rate is high, I'm proof that the right mindset, risk management, and strategy, consistent trading is possible. But it takes time, effort, and patience. Before I jump into my strategy and trade examples, let's quickly cover what day trading actually is. Day trading means entering and closing trades within the same session or day. That means I never hold positions overnight. I am focused only on intraday price movements. The main goals of day trading are to capitalize on intraday price moves, catching those quick shifts in momentum or levels that play out within hours or even minutes. To manage risk tightly, because traders trades are short term, risk management is absolutely critical. A small loss can be acceptable, but letting a trade run against you can ruin your days or even months of progress. Protect capital above all. Trading isn't just about making money, it's about surviving long enough to stay in the game. Capital preservation is always the first priority. To do this effectively, day traders rely on a few key tools. Charts. Price charts are the foundation giving us the structure of the markets. The day traders also rely on levels. These are zones of support or resistance or order blocks or fair value areas, fair value gaps. We will go over them in the coming slides. Setups. Specific conditions that align with a trader's strategy, like a fair value gap, lining up with a market structure break. Discipline. Probably the most important tool. Without sticking to a plan and rules, no amount of analysis will save you. So that's day trading in a nutshell. Quick, focused, disciplined, and always risk managed. Now that you have a quick overview of day trading basics, let me share my high level strategy. My approach is based on reading market structure and price action. I look for very specific conditions in the market that repeat over and over again. So I use the daily, the 4 hour, the 1 hour, and 15-minute time frames for my analysis, and my entry time frames most of the time is 5 minute, and sometimes I might use 15 minute. Um, I would also observe how the price reacts around the 4 hour and 1 hour highs and lows, and look for a specific candle pattern, for example, a fair value gap, a pin bar, or some other candles which I'm gonna go over the next videos. Let's cover what a fair value gap is. A fair value gap is a three candle pattern that identifies an imbalance in price movement on a chart. It indicates an area of rapid one-sided movement. This rapid movement leaves an unfilled space between the wick of the first candle and the wick of the third candle, ideally with the middle candle showing a large price move. and this is what forms the fair value gap. In the image here, you can see a bullish fair value gap on the left, and on the right, you can see a bearish fair value gap. We'll go over these in some more detail when we review some of the trades from the past week. Okay, so now it's time to look at the charts and apply the concepts that we learned today. So this is the Nasdaq futures chart, and I am based in the UK time zone. So the market opens at 1:30 my time in the afternoon. So this white area in the chart is when the market is open, and this is pre-market. Futures technically trade 24 by 7 with some breaks, session breaks, but we are not going to focus on that right now. We are only going to focus on fair value gaps today. Maybe I'll make another video about trading in different sessions. But for now, we are going to stick to the US session, which is 2:30 p.m. my time. So after the market opens, you can clearly see there is this three candle pattern that we spoke about. The first candle is a consolidation. This is an expansion candle showing strength by the buyers. And then there is another consolidation candle here. So let's start by marking the bullish fair value gap in this case. So you take the highest point of the first candle and the lowest point of the third candle, and that's what your bullish fair value gap is. So I have marked the bullish fair value gap. So now that was part one, identifying the bullish fair value gap or bearish, in this case bullish. So once we have that, we ideally would want a tap in the fair value gap, which basically allows the sellers to participate. And then we would want a move up from that tap for the bullish thesis to continue. So in this case, as you can see, we did not get a tap. So that tap logic doesn't come into play here. But then there is another way I trade a fair value gap. So if there is no tap and I do get an opposing color candle, in this case a red candle, and the high of the red candle is taken out, that's where I would like to enter long. Now, why do we have to wait for the high to be taken out? That's just showing us that the buyers are willing to take the price even higher. Oftentimes, you could see that a fair value gap is formed. There's a red candle, but you don't see a follow through. The high was never broken, so that's not a trade for us. So in this case, the high did break. So let's see if we get our 1 to 2 and our entry candle is our stop, and then we're going to aim for 1 to 2. So including the spreads, we did get our 1 to 2 around somewhere here. So we would have been in the trade for 2 hours. Now that's where patience comes into play. A lot of people wouldn't have to have patience to hold this trade, but that's where the confidence in your strategy comes. The confidence comes by doing backtesting sessions, putting a lot of work into looking at the charts and sticking to your trading plan. So this is one example. I have tested this numerous times, and this would have resulted in a 1 to 2 winner. So that would have been a winner. Now let's look at Tuesday, how Nasdaq played out on Tuesday. So this is when the market has opened. As you can see, there is a clear gap between this and this candle. So this is candle 1, then this is candle 3, and in this case it's a bearish fair value gap. So you consider the low of the first candle and the high of the third candle. So that would have been the bearish fair value gap. So we have marked it now. We would ideally want a tap in the bearish fair value gap, which would have given the buyers an opportunity to participate. And then we would like a follow through to the downside. But as you can see, similar to Monday, we never got a tap in the fair value gap. So then in this case, we don't use the tap entry model. What we use is the opposing color entry model. So what we want is an opposing color candle fairly close to the fair value gap, in this case a green candle. And because we are going short, we would want the low to be taken out. So in this case, this candle would have triggered this in, and then our entry candle is our stop candle. That's where we keep our stop, and then we aim for 1 to 2. So including spreads, around this time we would have hit our take profit, and we would have been in the market for again around 2 hours. So that would have been a winning trade on the short side. So I hope these trades give you some idea of what a bullish fair value gap is or a bearish fair value gap is. How do we use them? How do we use the tap entry model? Now on Monday and Tuesday we did not get that, but we did get the opposing color entry model. So that's it for the trade. A brief intro to the fair value gaps. Of course, there is plenty to fair value gaps. We will cover more as we progress into more videos, but that's it for now. I will be posting one video every week. Make sure you subscribe, like, and turn on notifications. And see you next week.